All right, everyone, welcome to the 10-part executive training series. I am Frank Ochoa, aka PivotBoss, and I'm excited to bring to you the part 2 of this training called price-based analysis. As you recall before, we have various components here to the PivotBoss method. Our theory component, which we covered in part 1, was auction market theory, helped us identify the auction process, also when to be a buyer, when to be a seller, what to look for with regards to price and value. It gave us all the key things in terms of theory that we need to know and hold true so that we can then analyze and execute trades in the market with the best of them. And of course, all of those materials can be found at the dashboard. Now we're starting our analysis portion here, and this is the price-based analysis that we're starting off with. Part 3 will give us volume-based analysis and so forth. In the price-based analysis, this is going to be very important here because price-based analysis is really where it's all about. When you're talking about the markets and analyzing any market, what you're doing is basically analyzing price and volume. If you can analyze price and volume, you can basically know when to buy and sell any market and do it with the right risk management. And now what we're doing here with price-based analysis is just showing you what's happening when price does certain things. Giving yourself information about what's happening based off of just price movement. So basically, price-based analysis is all about understanding the underlying principles of basic price movement so that you can become a more knowledgeable and confident trader. You have to be able to read the story of what price is telling you. So number one, when it all comes down to it, you have to know this thing. Number one, what moves price? What moves price? And obviously, you can see here on the slide, stops move price. So this is number one, and it's very, very important. Stops are what moves price. And again, for some of you in here, are grizzled veterans, big-time traders that have been around markets for a long time, you know this type of thing. But for other traders who may have even been trading for 10 years as just a normal retail trader learning on their own, this isn't something that you know inherently. This isn't something that you're taught inherently. You're taught to look for patterns or wait for a signal or lose this indicator to wait for whatever. You're not really taught exactly why price is doing what it is doing. And it's very, very important to know what moves price, and that is simply and only stops. Stops move price. The most important factor in future price movement is not where the market has been historically, but rather where traders are positioned right now. Right now. And that's all about order flow and stops. When the market gets too long or too short, late participants to the move will begin to exit those positions on an adverse move. And that begins to trigger stops. And that basically triggers a full-on reversal. And that's important to know. I mean, if you drop down into a chart, you'll see this over and over. And we're going to cover these concepts in the chart as well. I want to cover the rest of this here for a moment. You have to be able to know your competition. And again, so when you're trading, it's not just where you think you're going to buy or where you think you're going to sell. Professional traders that do this for a living and have done it at the best levels, know that you have to know your competition. You have to know why the market's moving up, why the market's moving down, and who influenced that move. Markets move higher when traders cover short positions because they are wrong. That's a short squeeze. Markets move lower when traders liquidate long positions when they are wrong. That's when buyers are getting slammed, right? So you have to know who's positioned where, and you have to know when they're going to be wrong in their trade. So when I say know your competition, you have to ask yourself a few questions here. Number one, you have to know who is positioned where. Who's positioned where? And we talked about in the auction market theory portion in part 1, we talked about who are the market participants. Remember, we have responsive participants, we have initiative participants. And then of those, we have a bigger category, which is OTF, other time frame participants, the bigger fish. Of the initiative and responsive participants, you have buyers and sellers. So you have responsive buyers and responsive sellers, and you have initiative buyers and initiative sellers. So when you ask yourself who is positioned where, it needs to be one of those responses. It needs to be responsive buyers are currently positioned at support, or responsive buyers are defending support. Responsive sellers are defending resistance. Initiative buyers are taking value bid. Initiative sellers are seeking range expansion, right? Those types of things. Who is positioned where? Because then it gives you a face to the trader that's sitting across from you, the one that's trying to take your money. After you answer that question, you have to ask yourself, where are they going to exit their trade? Where are they going to exit that trade? And that's number 2. So if you know who is positioned where, now where is that trader going to be wrong? Where are their stops? Because now you become a shark hunting for stops. And once you're hunting for stops, you know that if you find those right set of stops, when that trader is going to be wrong, you're going to be in for a great momentum trade, right? Number 3, you need to ask yourself, where are they going to defend their trade? So if somebody gets into a trader gets into a trade, you know who they are. Say a responsive buyer buys support. They're defending support. Well, where are they going to exit their trade? Maybe they put their stops below support. Where are they going to defend their trade? Well, sometimes they defend it on the first pullback after their entry. Sometimes they defend their trade when price goes against them. So you have to know where they're going to defend their trades, because that tells you where additional help will be, additional support. How can we capitalize on this information is question number 4. How can you capitalize on the current market environment where someone's positioned at a certain spot or stops are at a certain area? Are you going to gun for those stops? Are you going to try and be part of the wave that stops that trader out and get into the momentum move? Or are you going to be on the side of that trader and seek movement toward a shared goal? Once you figure that out, then you can then execute your bias. So this all comes down to, what is price doing? Why is it moving? Who is influencing that movement? And then executing your bias based on all of that information. Remember, after you buy, you are a seller. After you buy, you are a seller. And after you sell, you are a buyer. Trading is a zero-sum game. Every buyer has a seller, and one participant's loss is another's gain. So again, you are competing against other traders, even if you don't think it that way. It's if you get into a trade, you have to know why you're getting in. You have to know what's going to help your trade reach its goal. Again, I mention all the time, you could be, if there's a support here and it's bouncing, and you get in right here to defend that support, is price going to go up because you bought there? Is that why? Is your couple hundred shares or your few contracts going to be what influences price higher because you bought there? No, it has nothing to do with you. Instead, it has everything to do with the traders that got short there, the traders that got on the other side of your trade. Because if someone got short at support and price isn't going down, remember, after you sell, you are a buyer. So if they sold at support, first they were a seller, now that seller is a buyer. It is those stuck sellers that become buyers that lift price up, not you buying here. It's them buying because they have to get out, because their stops are getting run. So again, you have to understand what's happening at those levels and how and why price is going to move in your direction. And again, we have 6 key questions to ask yourself down here. And these are questions that all great traders ask themselves. And you'll see variations of these types of questions all the time. But number 1 is, which direction is the market trying to go? That's the easiest question. Which direction is the market trying to go? Is it trying to go up? Is it trying to go down? Or is it just staying in a range? What is it trying to do? And then how good of a job is the market doing at trying to achieve number 1? How good of a job is the market doing? That's another one. If it's trying to go down, is it going down easily? Is it going down? Is it having a tough time going down? Is there failed range expansion going on that could suggest a reversal? You got to be able to know those questions and ask those questions and get the answers to them. And then also, who is in control? Is it day time frame? Is it OTF? Is it responsive? Initiative? Who's in control of the move? Who is participating? Who's participating in this move? You know, who's the one that sparked it? Who's the one that's defending? Which one of the participants is it? Where is the market bid, and where is the market offered? Those are very important. You know, you want to ask yourselves, where's the market bid and where is it offered? Where is it bid? That means where are the buyers buying that? You know, that's what bid means. Bid with the bidders, buy with the people who are buying. Where is the market offered? Offer with the offerers, sell where the sellers are selling at. That's all it is. Align yourself with the right side of the market based on who's controlling the market, who's participating, where are they defending their trade, where are they wrong in their trade. Look at all those ideas and ask yourself what could happen. When we were looking at the ES earlier, let's jump into some charts now here. All right, let's take a look at some charts now. Here's the ES, okay? And we talked about this just a moment ago as it was happening live. But what I was talking about was who is defending where? Who's positioned where, right? Know your competition. Who is positioned where? That's number one. And right here, I told you buyers came in and defended. So you have responsive buyers here. Responsive buyers, RB. Responsive buyers. Price comes down again. Who's defending here? Another one, responsive buyers. Boom, okay? Again, same thing right here. Who's defending? Responsive buyers are defending this. Now, we ask ourselves, well, where are they going to exit their trade? And that's what I mentioned before. Well, they have stops here. Now you have more stops here. Now with this third rotation, you have more stops here. Okay, so they're wrong below support. That's where the stops are. Where are they going to defend their trade? Well, if price had gone up, you know, it could use a recent high as an area to defend, right? So you know that they're in here, and if they were to keep working out, then you start spotting where they can defend their trade. And then again, how can we capitalize on this information? So in this entire analysis of that information that I provided earlier, I said buyers were here, buyers were defending here, buyers defended here, and we have all the stops. So now we have the information. So how can we capitalize on this information? Well, buyers are here, here, and here. Just because buyers are trying to get price to come back up here doesn't mean they win. So how do we capitalize? Well, we capitalize by saying, well, all of these buyers right here are at risk of having their stops run because you have a downtrending market. The footprint order flow analysis suggested that buy imbalances were being offered. That was absorption. So that's why I said the best, most likely scenario is for a downside break. And now you just execute your bias. That's number 5. Execute your bias. From there, okay. Well, if it's going down, let's get the best entry we can. Where would that entry be? Okay. So then you get your entry. Obviously, there was a fantastic entry earlier, 1937s, that Viewer 91 came up with. Fantastic. Took it off on a perfect drop into 21s. Perfect. Right? You analyze the market, you see who's positioned where, you see what the overriding trend is. Remember, ask yourself these 6 key questions, right? What are the 6 key questions? Which direction is the market trying to go? I mentioned earlier, right after the open, that gives you the early analysis on which way the market's trying to go. It went offered immediately and easily. It's trying to go down. It bounced. It's being defended a little bit, but it was trying to go down. When we started really analyzing it earlier, we were right here when price had just bounced. So we didn't know any of this other stuff yet. We didn't know any of this. Instead, all we saw was this. Well, the market is trying to go down. It's trying to go down. How good of a job is it doing? Well, it was sitting near lows, so it's been doing a decent job, but now there's some support that's developing. And that support could help paved the way for more weakness, as it did. How good of a job is it doing at it? You know, again, this looked pretty decent. Who is in control of this move? Well, right here, price went offered at value. This is value. This is VPOC. And it went sold, offered. So that's initiative. Those are initiative participants right there that is sparking this move. And it could be OTF participants, but it's also just as likely to be any normal participant in this case to drop it down. And then you just ask yourself, where's the market bid? Where's it offered? Remember yesterday, I talked about the open. I said the open is offered. Where are we yesterday here? No, that's not it. I forgot which one we were talking about. It might have been, there it is. Yeah. So I mentioned earlier, I said, okay, the open is offered. So you ask yourself, where is the market bid and where is it offered? Okay, the market is offered. Here's the pullback and here it is. Remember, this is the open price. It's offered. Ask yourself, where is the market offered? Where is it bid? So if the market was offered at the open, a pro trader would say, okay, now I'm going to stick my limit order right here at the limit, and if it triggers sometime in the next few hours, then I'll go ahead and get in that trade because the open is offered. Or you can wait and wait and wait and see how it comes up and see, boom, it went up and then failed and rejected, and you go, okay, the open is still offered, I'll get in there. And you see it move. So it's just about asking yourself, where's it bid? Where are the buyers buying? Where are the sellers selling? In this case, you can see in the previous day, there was a big range that formed up here and then price dropped. And when it came back a couple of times to the open, that was sealing the fate here. And then all of a sudden you had a downtrending market, right? And then value was offered. So if I say VWAP is offered today, VWAP is offered, that would be this blue line right here, right? And that's offered. That's where the bears are currently defending. So every time price gets into that zone, it gets sold because that's offered right now. And this will change depending upon, what's happening in the market. Sometimes VWAP would be bid. But look at that. All the way up until the very end of the day, it was still offered perfectly off that level. So I will tell you at times what's bid, what's offered, and then, that's initial analysis right there. So those key questions, those 6 questions can help get you in the routine of asking yourself who's controlling things, who's influencing, where are they wrong, asking those 5 questions or those questions about the competition, who's positioned where are they going to exit, where are they going to defend. Those types of things are very important when you're thinking about getting into a trade. So these are all things that you have to know. You have to know these things like the back of your hand, because price does a lot of things that give you cues about what's to come in the upcoming period of time, and that's, again, it is paramount to know this type of information. All right, so we just finished this slide up. Now I want to show you price-based analysis here from this slide's perspective. And basically, this is all about paying attention to the cues that the market and price are giving you. You have to pay attention to what the market is doing. What is price doing, and what is it doing at certain levels? Acceptance and rejection are among the most important concepts in trading. So you must be able to recognize acceptance and rejection as soon as it's happening, because those are the earliest cues to what's to come for price. These are some important concepts here that, again, it takes time, it takes experience to learn these on your own. But if you have someone there to tell you about them, you grasp them so much faster. You grasp them, they start to make sense. It starts to connect dots. You get these aha moments. And again, not everyone has the same experience level in this room. So some of you know this really well. Some of this is a great remedial for you. And some of you, you've never even heard some of these concepts before, but it makes complete sense. And now you can start to see the market through an entirely different lens, a professional lens. So a couple of these things that we'll talk about is compression and expansion. So when we talk about basic price movement, compression and expansion are perhaps the easiest, oldest concepts to know, but it's something that just is a recurring event. That's why I mentioned earlier, when we talk about market tendencies, is it a market tendency that happens quickly, and is gone and you'll never see it again, or is it a market tendency that happens throughout time? You know, is it a market tendency that's kind of like a law of physics? Same thing with compression expansion. That is kind of like a law of the markets. It's not going to go away. It's just the way the markets develop. It's what they do. You're going to see expansion in a price discovery phase, and you're going to see compression, right? These are concepts we talked about in the previous part 1 training course, auction market theory, when we talked about balanced markets and imbalanced markets. Compression would suggest a balanced market. Expansion would be an imbalanced market. So the development of trading ranges, like compression, builds the energy that will lead to the next phase of price discovery, expansion. That's super important. The development of trading ranges builds the required and necessary energy that will lead to the next phase of price discovery or expansion. The more positions that build up in the area, the bigger the price move will be once one side bails out of their trades. The resulting move is either a short squeeze or a long liquidation. So again, these trading ranges are very important because building up a trading range builds the energy, because you get all the traders that are trading in here, and now they're putting buy stops above the range, sell stops below the range, and once you see expansion, one of these stops are going to trigger the next phase of movement, and you're going to see one side or the other get squeezed out of their trade. So this is very important concept. Now, weak hands is something that we should know about as well. Weak hands are positions held by short-term speculators who do not intend on holding a position for long. So these aren't someone that's going to hold a multi-point pullback in the ES. They're not going to hold a multi-day pullback. I mean, they're holding long. They're trying to see if they can, if they can stay up. But any movement against them, they're getting in and out quickly, right? It's a weak hand. And a flush occurs when the market flushes the stops in one direction to shake out the weak hands in order to remove orders that are creating resistance in the opposite and desired direction. And this is something that is seen often with regards to failed range expansion or expansion of any case. So we're going to look at and talk more about what those look like in the market. And additionally, we have failed range expansion. Failed range expansion is one of the most powerful concepts of all of trading. And this is something that I hold near and dear to me, because the first times that I really started to pay true attention to failed range expansion was when I felt like a genie. I felt like someone with a crystal ball, because I remember cleanly one time price holding. This was years ago, and I was watching the market. I happened to have the previous week's low up, so it looked like this. And it was Monday morning, and price came into the weekly low, and then boom, was holding like this. And then, and the previous week's range was so high, it was so big. I mean, it was way up here, week's high. It's just such a big range. And then once price popped back above here and held, I noticed, this is a trap. And anytime you fail to see range expansion, you're likely going to see a move in the opposite direction toward the opposite side of the range, which has an accuracy as high as 80% at times, which is a major concept in trading. You just don't get those types of percentages. The first time I saw that work out and play out, and I saw it live and diagnosed it live many, many years ago, I mean, I was like, wow, this is phenomenal. If I can just do this only, at these key levels, only look at the previous week's high, only look at the previous week's low, and see what happens at those levels, you can get moves like this. And this is still one of my favorite approaches to engage in the market. So failed range expansion basically occurs when the market attempts to seek a price discovery phase and expansion from a given balanced range. But when the market's inability to establish acceptance beyond the range occurs, this becomes a shining beacon that stops her at risk, and a significant reversal across the range could be seen. And we'll look at that in the charts as well. More key questions to ask yourself: what are you thinking? Because chances are thousands of other traders are thinking the same thing. Also, what is the trader on the other side of your position thinking? This is helpful insight that could help your trade. And again, at which price point will your opponent give in and accept a loss? So again, these are all comes back to knowing your opponent, knowing who's trading, knowing the participants in the auction, so that you can get a better idea of what's going to happen to price once you're actually in the trade. So let's transition again over to the charts. All right, you should see my chart now. So when we're talking about the concept of compression and expansion, you know, here's a chart in crude oil, and this is just so easy and apparent. We all know this, but right here, this is clear compression, right? Clear compression. Boom, 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 boom. But what's happening inside there is less obvious to traders unless you've been around the markets for a long time. So in this, what's happening here is price comes up to a point where it finds balance. It finds balance and a happy facilitation of trade between buyers and sellers, right? That's what's happening here. And since this is an area of balance and is an area of acceptance, you can see kind of the little HVN that forms here. That tells you the market's happy. The market's happy trading in that area. But once you start to see significant compression over time, now you have a market that's either too long or too short, and expansion is going to put their stops at risk. So what I mean by that is, if you put this up like this, you have buyers that came in here and here. Then you have buyers that came in here and up here. And then you have buyers that came in here. Okay, that's at least 1, 2, 3, 4, 5, 6 rotations. So you have all these stops from 6 rotations, sell stops, sell stops. Up here, sellers here, sellers here, sellers here, sellers here, sellers here, sellers here, and here. And they put their buy stops up here. So if they're wrong, they get stopped out. And some people have higher tolerance for stops than others. Same thing with down here. Some people have stops that come all the way back to here. So as you're trading and building up throughout the time, you're getting more and more stops on each side of the range. So whenever one side of the market or the other is forced out of their trades, the stops start to trigger. We closed outside of the range here. The next session, price tested price levels inside the range and were rejected, and price pulls back out of it and closes back out of it, second straight range in a day, second straight day in a row. And then you see the first major slam. Then you see a little sideways and you see another slam. That is exactly what happens when you have compression and expansion. This compression, this trading range is the fuel that builds up, the fuel that's going to spark that phase of expansion, either up or down. And eventually you get a significant move like we saw there. So that's basically compression and expansion, right? If the market sees a nice phase of expansion like this movement, you're usually going to see it go sideways and quiet where the market can facilitate trade. Once it's done there, you're going to see a big phase of expansion, and then it'll build another range by which it can do business and conduct business and facilitate trade. So if you move this thing over to the right, that's what it did here, right? So after you see this big move here all the way down, you usually see a snapback and then a range form. And that's another trading range that builds energy and fuel for the next phase of expansion. And that's what we saw here recently and still are seeing now. So that's compression and expansion. And it's very important to understand what's happening that can fuel those moves. You know, it's all about the stops and those traders coming in the range. Now, what's important here is when you start to get, let's take this one off. When you start to look at ranges as a whole, you know, it's all about price range. The market is an auction. So when you're looking at this and you see failed range expansion, for example, What's happening here, remember, what's happening is this is a range that formed from 53.30 down to 41.72, and then here's the midpoint at 47.51. So for all intents and purposes, what happens is the trading range forms from 47.51 here up to 53.30. And you see the trading range develop. Boom, 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 boom. Well, what happens here is price attempts to push beyond the top of the range, but fails to hold above that range. That's range expansion that is failing. So that's failed range expansion. You have the top of this range here, and say you had buyers that came in off the bottom, right? And buyers that came in off the bottom and off the bottom, off the bottom. I was actually telling our premium members to buy those levels. Buy, 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 buy. Every time it hit it, buy it. And then price, you have buyers that came in here and it went up. Buyers that came in here went up. Buyers, buyers, buyers. And then you have somebody that bought way up here. Somebody bought that. Remember, zero-sum gain. For every buyer, there's a seller. Someone sold up there, but someone also bought. This first buyer up here bought, and price immediately started to go against them. And so they're like, oh crap, I'm getting out. So then their stops are triggered, and their sell stops lead to more, and whoever got long here and here and here are all thinking, uh-oh, uh-oh. And then their stops are triggering, and now there's a full-on failed range expansion, and all the stops of everyone that started to get in all up here start to get out, triggered, 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 until it hits all the stops that were as low as 45.80. And then it bounced back up. So that's what's happening on the failed range expansion. The idea is if price can't hold above the top of this key range, then the market is likely going to auction back toward the opposite side of the range. And that's what it did here. Perfect, perfect, perfect. And that's what you would expect. So range expansion can be one of the most phenomenal momentum breakout opportunities, but failed range expansion can lead to a move that's as powerful or more powerful. In this case, you can see here below the range, it tried to hold here below, it couldn't, and then snapped back up, and then you saw a move back higher. So this was a failed range expansion on the downside, at least short term, and you saw a move back up within the range. So that's the type of concepts that happen all the time. And what happens is sometimes it says here, sometimes you need to flush out the weak hands, right? In order to remove orders creating resistance. And you have to shake out those orders in order to get it to go to the other side. So what you see is, this is the best example right here, is when price comes down, buyers get in and boom, it pops up. And then you see immediate selling that comes in, and then it comes down a little bit, and then it pops up and more selling, pops up and more selling, and pops up more selling. Those are selling. There's resistance there because there are weak hands that have bought here, and they're putting their first sell targets here. So all of that resistance created by sell orders are actually the buyers here that are long, that are just trying to sell for something for a profit. They also have their stops here, right? So they have their sell stops above for a profit, sell stops below for a loss. And then say price holds here, and then it continues to rotate. So now you're like, okay, I'm going to move my stops up to here, my bottom stops. So now you have this clean area, and you have stops that are here, but you still have sell stops up here because you're trying to, every time you get in, you're putting sell stops. So in order to flush the weak hands, you'll see a day like this where price comes down below that support, triggers all of these stops, which what happens is by triggering these stops, you take this person out of their trade. And when you take this person out of the trade, you take their stops and you take their sell stops above out of the trade as well. So now what you're doing is, if you had this guy long with this sell stop and this sell stop, when you take out, whenever he puts that sell stop up or wherever, whenever that sell stop is triggered, you're also removing the sell stops above, and that creates a clean path for things to move higher. I know it's a long example, it's not the perfect example, but that's what's happening. And it was happening big time in this zone because this was a buy here, but it wasn't going up. It wasn't going up. And even when it went up, it was being offered. So what you had to do was come back down, dip down, shake out those hands, take those traders out of their positions and take their sell stops off the table so that there's an open resistance doorway just to push through. So that's what's happening in that scenario. And that's very important to understand. Those weak hands, flushing out those orders. So sometimes the market has to probe through. So that's all that's happening there when you're flushing out these orders. Now, of course, the big thing is the bigger the trading range, the bigger the compression, the bigger the resulting move. The smaller the trading range, the smaller the compression, the smaller the resulting move. The same thing with value. I mean, value, the bigger the HVN, the more value, the more significance that value holds. The smaller the HVN, the less significance it holds. Same thing with the trading range. So knowing these concepts is very, very important. Again, some of you are pros and may have heard some of this stuff before. Others may be hearing this for the very first time. But this type of information just doesn't change. It's just the way the market operates. And so it's important for you to understand how the market operates so that you can diagnose it quickly. And once you diagnose it, you can engage the market in a more informed manner. So basically that concludes the price-based analysis portion of part 2 of the executive training series. Price-based analysis, again, is very, very important. Anytime I'm looking at a chart, I pride myself in the ability to be able to analyze any chart just off of price by itself. Again, those 10 portions of analysis, or 10 boxes here of our PivotBoss methodology, these are all various ways to view the market. All of them are different ways to view the market and analyze the market, but any one of these ways in and of themselves can be used by themselves to give you everything you need to know about price. So when you're able to then master each of these concepts and just blend them together seamlessly, that's when you've really gotten a whole nother level of control of the methodology. So with price-based analysis, again, it's all about understanding who you're up against, who is positioned where are they wrong, where are the stops, what phase is the market in? Is it a compression phase? Is it a trending price discovery phase? Is there any signs of failed range expansion, or are there signs of confirmed range expansion? All of these things really signal at what's happening in price in the upcoming period of time. Additionally, a market that develops a range for, say, 2 or 3 months, whenever you see expansion from that range, you can expect expansion of about 2 to 3 months. So it's kind of time-based as well. And that's something to keep in mind. If you've been trending for 2 or 3 months, then look for the range that develops after it to be about a 2 or 3 month trading range. And again, being able to diagnose when those shifts and changes occur, being able to diagnose that in the quickest manner possible really helps give you a leg up in understanding or forecasting where price is headed in the upcoming period of time. So that basically does it for the part 2, which is price-based analysis for the 10-part executive training series. Again, I want to thank you so much for being a part of the PivotBoss Premium Trading Room, and I'm looking forward to parts 3, 4, and the rest ahead. So thanks a lot for joining this session. I want to say thank you, and I'll see you soon.